Okay, so just the ones you had there, right? This one, the topics one, is all we'll be using after Christmas. I'll show you there now.
Should I have it, sorry?
No, I'm not finished it quite. I'm still focused go through the basics still. Well, I'm not going to use these a lot, don't I? Just these are for after Christmas.
Alright.
So when you're after photocopying off the loan, you'll just give them out.
That's so good.
That one there with topics written on it, that's one we'll be using after Christmas for the new rules for capital gains tax, acquisition tax, stamp duty, taxation of estates. Okay, that's what we'll be using. So just make sure we bring them with you every night. And then we have just a small one there, agricultural relief, Cat 5. It just inside the capital acquisition tax is a specific relief for agriculture if you have a farm. And if you're transferring the farm, there are certain rules that apply to that. And then this is actually very good. It's actually off the revenue website. It's CGT Guide to Capital Gains Tax. And I go, oh my God, what you going to do with us now with all this revenue stuff? But it's actually very good. It's actually very, do you know what I mean, easy to read. Once I show you where you watch it. No, but it's actually very good. And it's actually a lot of examples in it too that hopefully will help with the more difficult areas of what we'll be doing. Yeah, we do. Yeah. So it's actually very good. And if every word, I mean, if you're out in the real life and you're actually looking for capital gains tax stuff, go on their website. It's actually very good. And if you look at, see the back of that book, it says Revenue Commissioners, March 2014. It tells you when it's actually after being updated. So it's that updated in March 2014. So like if you were in 15 then you needed new information for 15, there'll be a new one updated there beside that as well. But it's very good, I find anyway. Even the examples are very clear and stuff, but that's for after Christmas anyway. And it's like this, like there is 30% of the exam is capital gains tax, and it's at level 3, and 30% of the exam is capital acquisition tax, and it's at level 3 as well. Make sure there now. Yeah, no, 30%, sorry, yeah, 30% altogether, 15% for CGT, 15% for CAT, and 5% for stamp duty. Talking about 35% of the exam from this part of the course alone. And they're at level 3, so there's a high standard of knowledge needed, and it's guaranteed, yeah. And there is a load of questions on it in the papers. Like, what I've just, I mean, I've gone through the theory like I normally do, and then doing the exam questions on it.
What's the pass? 40 again?
50, I'd say. 50, yeah. And then you see tax planning, the estate planning is actually a level 2, and that's tax planning through Succession Act, Agricultural Relief, Business Relief, CGT, CAT, Stamp Duty. That's 30% of the exam as well. So like you're talking about 65% of the exam. We're incorporating.
Do we have that?
Yeah, I gave that there one of the first nights. We can print it off their website as well anyway. And like our corporation tax we've done is 20%. So like, and the VAT is like another portion of it. So like once we've this done, we want to have income tax to go through.
So these are all guaranteed questions, like that? Well,
oh, guaranteed, yeah. And Richard even said that this is a main focus, CGT, CAT, and the tax planning around that and the state is a main focus for the exam. And so we're learning a set of rules. Well, it's easy for me to say, we're learning a set of rules for it, do you know what I mean? And it'll be okay.
Yeah, I have it.
and what is much income tax?
No income tax is actually 15%. But that we have to go through, I can see commencement and cessation and stuff came up last year in it.
Yeah.
So I want to go back over bits and pieces of income tax as well. But then there's termination payments, like if you're made redundant, how you actually would tax the redundancy and stuff like that. And double taxation treaties. So if you're if you income from England or abroad, how it's actually treated here as well. And then losses. and losses are grand. There's only two. They're not like Joe losses and corporation tax with 5 different things to actually do. We only have 2, Section 381, Section 382, current year loss, prior year loss, and that's it. It's grand. Oh, and the high earners restriction, that actually comes up a lot. If you're a high earner, what you actually can do inside that. And it's actually okay. So, but that's me, I'm saying everything's okay. I don't mean to say
No, it's not too bad.
it's not too bad, really. Okay, so we'll just go back and do a little bit more on just our basic stuff, and we'll finish up then. We'll say 20 good minutes and we'll be started. Okay, because I just want to go through the theory, get the theory out of the way for this part, and we'll do questions and stuff then when we come back. Okay, so our chattels. So we've got 2 different types of chattels, wasting chattel and a non-wasting chattel. So your wasting chattel has a predictable life of less than 50 years. So talking about television, car, sailboat, and they're actually exempt from capital gains tax. Whereas we've got a non-wasting chattel, jewellery, antiques or work of art, they're chargeable to CGT. Proceeds of less than 250 are exempt from capital gains tax. Exemption applies to each non-wasting chattel disposed of in a year of assessment. So every time you dispose of a painting, piece of jewellery, an antique, if they're less than 2540, then there's no capital gains tax on that. May qualify for marginal relief if slightly over 2540. And your formula, which we'll be using after Christmas, is proceeds minus 250 multiplied by 2. So you actually reduce the amount of capital gains tax you actually might have
If you
to
sell
pay.
some 226.
Yeah, if it's you could even go up as far as 3,000 maybe, and you still get a little bit of marginal relief. It depends on whether you sell another asset or not. If you don't sell another asset, you have maybe a exemption left over, so you could use it. But it depends
You're
on.
better off selling, if you're something that you're selling for 260, you're better off giving someone 100 quid off.
I'm selling it for 2.5 and there's no capital gains tax then, yeah. Sale of chattels in sale is treated as one disposal. What I mean by sale of chattels is like if you had an antique necklace with a matching antique ring, antique earrings, and antique bracelet, then that would all be set in one set. You couldn't sell the necklace for 2.5 and the earrings for 2.5 and the ring for 2.5. Do you know what I mean? And you put them all as separate, you take them as one thing. Lots in when sold for less than 250 and a loss arises in the process are deemed to be 250 and this reduces the loss allowed. So if you sold something for 2,000, if you sold something, if you had an antique say for 10,000, okay, and you had you sold it for 10,000, you bought it for 8,000. So if you've that's making a profit, €2,000. If you had something for 8, sold something for 8, you had bought it for 10, it means a loss of 2, okay? But that loss actually becomes 2,540. No, that's not the right way. That's the wrong way to explain it. Go back. If you sold something for
2,000.
for 2,000 and you had bought it for 3,000, you made a loss of 1,000. Okay, your proceeds actually become 2,540. Your cost price is still 3, so you're actually making a loss only of 460 instead of 1,000.
The loss that you're allowed to use.
Yeah, reduce the loss you're allowed to use. Okay, so if you look at the examples there, a painting is sold in April 2004 for 3,200 that cost 1,400 in 2004. So you're actually looking at margin relief rates there. So just put this up here 1 minute. Okay, so we've got our painting. Okay, and our proceeds are €3,000. €3,200. See, it cost us €1,400 in 2004. So in 2004, there's actually no indexation. Once we went past 2003, we've no indexation. So 3,200 minus 1,400 would give us a gain of 1,800. Okay, and if you multiply that by 33%, yeah, if we presume he has more gains now in this one, okay? Okay, so 1800 by 33% is 594. So the moment your tax liability is 594. But if we apply margin relief, okay, we take our proceeds, which is 3,200, minus our 2540. It's giving us 660, isn't it? That should multiply by half, and that's, I think my thing is written down there wrong. That doesn't make sense.
Multiply.
by two is
Six to multiply by one.
That'd be 12, 15, 20.
So we need one, 20.
It'll basically bring you up to allow you,
I think it's multiplied by half.
allow you to sell it for what, 3.8 or thereabouts.
So that'd be 660 multiplied by 0.5, which would be 330,
Yeah.
which would make more sense. But I'll just check that there. I think my
Probably in the
thing,
book.
yeah, it should be in the book.
Page 387.
387, non-chargeable assets and reliefs. Is it on?
half.
Is it half?
Yeah.
Yeah.
Half of them. 388.
Yeah, multiply by half. Just change that in your notes there. No, that couldn't be right. Multiply by 2. Multiply by half.
Is there a section on marginal relief in that, or is it just used in the example?
In the book,
Yeah,
yeah, just there on, it's on page 280 to 388.
that's it, kind of used in an example, but is there kind of a like marginal relief for the liability as follows? Doesn't actually give the formula there, does it? It uses it in using the figures in the example, but it doesn't actually.
Yeah, it's there with 5 paragraphs down, 4 paragraphs down on 387.
There,
Where
three,
the consideration exceeds 254 as marginal relief, which is tax payable to one half of the excessive proceeds over 254.
yeah, it's there, and see there on top of page 389, they've done up then as a, on the top of page 389, they have a margin relief fund done.
Yeah. The actual explanation there is 387,
387.
with 4 paragraphs down there. Where consideration exceeds
Exceeds
254.
254, there's a margin relief which restricts tax payable, not the gain, to one half of the excessive proceeds over 2540. Okay, so a company or a trust cannot benefit from this exemption. If you want to highlight that part of it.
It's a harder book to look at into than the accounting technicians one.
Yeah, there's actually more
It's just like a block of writing.
of
There's no-
writing. It's just, there's so much information inside in it. But that first one there is our margin relief, so we multiply that by half, which gives us a CGT of 330. Okay?
That's the relief is 330, isn't it?
No, that's your
Oh,
actual
that's-
tax.
Is that
Your
not,
330.
594 minus 330 now?
No, it's a lower one. 330 is your actual
it's
tax.
lower.
Yeah. Whereas if we go up here now, saying he had no other disposal, they took off 1270 off of it by 33%. They'll pay €175. So if you've no other gain, do you know what I mean? You're better off using take your 1270 off it and do it by 33%.
So it's just lower to start to 594 minus 330?
No, the 330 is your actual capital gains tax. It's after malfunction because I stood in it.
Took exception.
Sorry?
Took exception.
What is it, the USB keys?
Yeah. Okay, our next one, a painting is sold for in April for €2,000 that cost €3,000. Okay, just put an extra knot there in 2005. Just like what I was saying earlier on. So we sold it for 2,000, cost us 3, so we actually made a loss of 1,000. But you actually take 2540 as being your say your proceeds figure, so 2540 less 3,000 gives you a loss of €460. So you're actually restricting your loss in that way.
You're trying to save it onto it, is it?
I have all my stuff on it, you say. It's not recognising it.
Or you're trying to open something off it, is it?
I saved my workings onto
Open here,
it.
so I'll borrow it.
Yeah, if it doesn't go through, I'm going to do it before I go home, just so I'll have it. Thank you. Okay, and then our last one. Joe sold a painting for $10,000 in May 2014. He purchased the painting from his aunt in July 1999 for $1,000, and the market value of the painting in July 1999 was $2,200. So this is our market value rules we're looking at here. So our proceeds are going to be $10,000, and our cost figure is going to be the figure at July 99, which was $2,200. Okay, and we ignore the 1,000 for when his aunt purchased it, because it's the connected person, Johnny's aunt gave it to him, so or it's an inheritance anyway. No, sorry, it's not. He purchased the painting from his aunt, so what he gave her 1,000, but it was actually market value was 2,200, so it's the market value rules. Yeah, so if we're doing her tax in, she'd have to pay tax on the 2,200, but it would be exempt anyway because it's below the 2,540. Okay, if we go back to page 4, just give one read down to this and we leave it in for that, okay? And we'll do, if you could read over it, maybe if you do get a chance at Christmas, and we'll do a lot of questions in the night we come back. So shares, every purchase of shares on a separate date is treated as a separate asset, disposed on a first in, first out basis, and part rules apply when part of the holding is sold. So on the 15th of December 2004, Frank sells 1,200 shares in A Limited for $3,600. His purchases were as follows: 1,000 shares in May 2001 and 500 shares in May 2002. So we do them as two separate transactions. We take the first 1,000 there as our first lot, and then we take 200 out of 500 for our second computation. Page 4. Okay, so do it as two separate items. And just, if you want to put in there, just to, from your book, there's two other rules about bonus issues and rights issues. If you want to, I'll just give you the pages there. Okay, so like if you get a bonus issue, you know, from in shares. Sorry, just 1 minute there. Now I had it gone down, but it's actually after moving. Shares 373. Oh yeah, it's marked there. So a rights issue on page 375. Okay, so it's rights issue. There's new cash paid by a shareholder and the taking up of his rights under a rights issue is treated as enhancement expenditure at the date on which the cash is paid.
Sorry,
Page 375. Okay, so if it's new cash is paid by a shareholder and taking up of his rights under a rights issue is treated as enhancement expenditure. But if you look at the third last line, for the purpose of applying the first in, first out rule, the rights in shares are effectively deemed to be part of the original holding acquired on the same date as the original holding was acquired. Just to highlight that part there. I will go into more detail on that in our next class. Okay, so they're looked at as enhancement, but they're actually looked at as being, because you're first in, first out, you're going back to when you originally actually bought them. That's for rights issue. And if you go over the page, I'm looking at a bonus issue. And bonus issue is on page 377. They're number 21.4.3. Page 377.
I'll have to start taking those next book to pay with me.
Or those are tax book to bed all. Take the notes. Jesus, it's too heavy to read that tax book and page. Unless you didn't stand. Okay, for our bonus issue, for the purpose of the first in, first out rule, shares acquired as a result of bonus issue are deemed to have been acquired at the same time as the original holding to which they relate. Okay, just look at that. So we're looking at they look at the same dates that you actually got them. Even though you might have got them 5 or 6 years later, you still go back to the original date that you got them for your first in, first out rule. And we'll be doing some of them later on, but just to know that that's actually there as well. We wouldn't have done rights issues and bonus issues before, they'd be new. And then there's one more thing, if you go to page 378, it's acquisition within 4 weeks of disposal, and disposal within 4 weeks of acquisition. These are called bed and breakfast rules. So you bought shares and you disposed of them within 4 weeks. And this is the primary and anti-avoidance provision designed to prevent taxpayers benefiting by the creation of artificial losses. Okay, and we'll be going through them. I'm not going to go through them now tonight at 9 o'clock at night. Okay, so we're looking at the sale of shares, first in, first out. We've got our bonus issues, we've got our rights issues, and then we have our bed and breakfast where you're buying shares and selling within 4 weeks of each other. I will be going through all them. There's 3 new things onto what we would have originally done on shares before. Okay, if you just look at your part disposal, and read part disposal and read principal private residence, and we'll be started in with our theory. So part disposals, portion of the asset is sold. So it's like we say someone bought 10 acres and are now selling 2 acres of it. So you're part selling your property. Or if you bought a house and you turned the house into 2 apartments and you sell one of the apartments. Proportion of the cost relating to the purchase will be allowed in calculating the gain, and you actually have a formula. So it's the original cost of your asset multiplied by A all over A plus B, and A is your sales proceeds for the part disposal, and B is the market value of the remaining part of the asset. Okay, so Michael sold 4 acres in 2004 for 200,000. He inherited 10 acres from his father in May 1999. The market value on the date was 275,000. His father had originally paid 5,000 for the land in May 1975. So we ignore what his father has paid anyway, and the value of the remaining land is 300,000. So taking your original cost of the asset, so our original costs are market value of 275 multiplied by, okay, so you got 275,000 multiplied by A, which is the sales proceeds, which is 200,000, all over your sales proceeds plus the value of the remaining land, which is 300,000. So you've got 275,000 multiplied by 200,000 all over 200,000 plus 300,000. So that is 110,000. Okay, so taking 200,000 and dividing it by 500,000 and then multiply that by 275,000. Gives 110. So what that is, that's your cost figure for that particular transaction. Okay, that's your cost figure. That's what you use your part disposal formula for. Okay, that's our part disposal. So our next one then is principal private residence relief. So our main residence plus up to 1 acre around the house. It can't be like your house is here, okay, and your acre is like 10 miles over the road. It has to be an acre around the house. You calculate the gain arising as normal, calculate the period of non-occupation, and the exempt part is calculated as gain multiplied by period of occupation all over period of ownership. So, deemed occupation is any period during which the individual worked abroad, period not exceeding 4 years during which the person was obliged to live elsewhere in Ireland as a condition of their employment, and last 12 months of ownership provided the house at some point previously qualified as a principal private residence. And point 1 and point 2 there, okay, you actually have to come back and live in the house, okay, for point 1 and point 2.
So you get away for 4 years for work, but you have to come back and live in
You
the
have
house
to come
then.
back and live in the house again. Or you can go abroad for an unspecified period, but you actually have to come back and live in the house again.
Is there a minimum length of time that you have to live in?
They don't give for working abroad.
So 1 day.
Come back and live in the house for 1 day.
Oh, will you come back? Oh no, you mean, I thought you meant to go live abroad.
When
Oh
you come
no,
back.
if you came back and lived in it for a month, they wouldn't allow that. It has to be longer than that. You actually come back and live in it. They don't specify a time, but they won't look on a month as big enough. You get the last 12 months automatically anyway, yeah. And then the deemed residence only apply where the house occupied by them as a main residence both before and after the period of absence. And they have no other residence qualified as a principal private residence at that time. And that actually changed a little bit this year. If you have someone living in another house belong to you, a spouse or a mother or father, that may actually qualify as another principal private residence as well. So say you separated and your spouse actually living in another principal private residence, another house belong to you, it may qualify for principal private residence relief. But there are a set of rules for that as well, which you'll be learning after Christmas as well. Because if you look at your front of your book there, just there's reliefs, and that's where we'll be honing in a lot now. So see there, chapter 22, special CGT reliefs, principal private residence relief, replacement of business assets, rollover relief, rollover in relief in respect to disposal of certain rental properties, rollover and disposal of certain shareholdings, transfer of business to a company, and that's a big one, transfer of business to a company, that comes up a lot on the exams. Retirement relief comes up a lot as well. Disposal of a site to a child, relief for disposal of shares in a subsidiary, capital gains tax relief for certain disposal of land or buildings, farm restructuring, capital gain tax relief, and entrepreneur relief. So it's like the reliefs that are asked a lot, do you know what I mean, in this one, but we have to know the basics before we can actually learn the reliefs. And then the clawback of a relief. So a relief is allowed, but only if only you maybe hold on to land for 6 years. So you have to know the clawback rules in as well. Because in capital acquisition tax we have agricultural relief and we have business relief. So like there's a lot of reliefs to be actually learned inside there. But we get through it, and like I know it's a lot of theory, but once I start doing the questions, it gets easier then, and there's loads of questions for us to actually practice on. Okay? So we leave it there for tonight.